All right, from 1.5 to 2 in 1 year,
Yes,
500,000 tons of additional demand in
absolutely.
2026.
Absolutely.
That's insane.
The chairman of both Ganfeng and Tianqi came out to give these numbers. So I'm not the only one that's calling for a 33% growth in the market this year.
Welcome back to Rockstock Channel. It is Thursday, January 8th. As we begin our 8th year podcasting about lithium and other critical minerals, we'd like to thank all our listeners and viewers and wish you all a healthy, happy, and prosperous 2026. Today is a Rockstock recap episode with our good friend YJ Lee in Singapore. Rodney will be back next week. We'll focus today mostly on lithium, but also silver and a little bit of gold, for which YJ and Matt, in particular lithium and silver, have been flagging for much of last year. And before we jump in, I just want to take a couple of minutes to frame today's discussion. If you've been watching Rockstock Recap over the past year, you'll know that lithium didn't turn bullish overnight. What looks obvious today was anything but obvious at the time. Last March, we interviewed YJ in a conversation which had a title, Lithium's Imminent Demand Surprises. At the time, the market was still fixated on oversupply, but YJ was already focused on something very different. The demand shock coming from battery energy storage, commercial vehicles, trucks, and entirely new applications unlocked by falling battery costs. Then, in June, we had Ken Hoffman on for a conversation we called Lithium's Turning Point. Ken was unusually direct, arguing that the market was misreading the cycle and that the seeds of the next upturn were already being planted, even as prices continued to slide. Also in June, Matt Fernley joined us, before he formally became part of Arcane Equity, to talk through which parts of the lithium equity universe actually mattered at the bottom of the cycle. He highlighted low-cost financeable producers like Lithium Argentina and Sigma Lithium, long before the broader market was willing to look there again. That same month, YJ doubled down at the Fast Markets Live Lounge, continuing to press the case that lithium demand wasn't broken, it was simply being misunderstood. By July, Matt officially joined Arcane Equity, and we laid out a broader framework in The Critical Minerals Supercycle is Here, tying lithium into a much bigger story around grids, energy storage, electrification, military applications, and strategic materials. And then in August, we put opposing views side by side in a debate between YJ and Chris Robb, Lithium Bull versus Equity Long, which in hindsight captured the exact tension that the market has been wrestling with ever since. Fast forward to today, and you can see how that debate has started to resolve itself. Our Arcane Equity Lithium scoreboards, which track producers and developers across the sector, have turned into a sea of green over the 1 month, 3 month, and year-to-date periods. That kind of broad-based equity response doesn't usually happen unless something more fundamental is shifting underneath the market. Just yesterday, Benchmark Minerals Intelligence published new analysis showing that battery-grade lithium carbonate and hydroxide inventories in China have been steadily drawn down since late last year and are now at their lowest levels of 2025. With inventories depleted, prices have become more sensitive to marginal changes in demand. That inventory story is something Matt has been heavily focused on, and it's also where some of the healthy tension in today's conversation comes from. Matt has been more cautious than YJ in recent months, particularly around how much lithium inventory may be embedded in batteries and the fact that ESS installations can lag shipments. So we're going to unpack that properly today. Before we do, I want to flag an article we published, which was an update to the Strategic Lithium Reserve white paper we published last month. We compare lithium not only to rare earths, but also to uranium. If you find it compelling and want to help socialize it in Washington, please read it carefully and reach out to me directly at rockstockchannel@arcaneequity.com. I also want to flag a video we recorded yesterday with Advanced Energy Minerals, AEM, which recently went public, a high-purity alumina story, which will be published next week. And finally, Matt will be publishing his 2026 outlook on battery materials shortly, covering lithium, graphite, nickel, high-purity manganese. You'll find that along with our strategic lithium reserve work at blog.rkequity.com. And finally, just quick housekeeping before we start. We may discuss public companies today in which we own shares or are strategic advisors to the company, but nothing in this video is financial advice. Please read the disclaimer and at the end of this video. And with that, let's get into it. Lithium inventories and why this rally feels different from the false starts we've seen before. YJ, welcome to Rockstock Channel once again. And hello, Matt. Happy New Year.
Hello. Good. Hello, Howard and Matt. Good morning to you guys. It's really great to be back here.
So is it time to short lithium equities, YJ?
It's definitely gone up a lot, really, really quick, but I wouldn't go short. I mean, unless you have a super high risk appetite.
Okay, so what's going on? I mean, we're getting so much inbound here. Like we're having start of the year conversations. What's going on with the lithium price? Everyone's asking.
Oh gosh, I mean, who could have seen the lithium price going to 100 and almost 150,000 yuan in China in the first week of January? I mean, people were saying that was the target price for the end of this year, right? So we're there. But I mean, there are signs that the market is getting a lot tighter than people think. And finally, some of the numbers, like the inventory numbers that Matt is following very closely, are starting to show that.
Okay, so why don't we talk about that? But it's the nature of lithium and China dominating lithium trading is that, like, as the prices are going down, everyone pulls back, right? And they wait until it turns, and it just goes down. But then as soon as it turns, the fish move in a different direction, and they just chase it up. So that is a dynamic. So how much of this is an SMM kind of says it's sentiment driven, it's not necessarily operational driven, but some people argue that they're just a mouthpiece, trying to talk down the price.
I mean, to a large extent, we can track the price move late last year, to the first closure of the CATL mine, the Jinxiawo mine, correct? So when that was announced, there was a spike, and then of course CATL did their usual price management actions, and then caused that spike to completely disappear, and then it came back down to where it was, and it stayed there for about another month or month and a half until I think mid-October. And then it's just been up and away. So I think this is not about people holding back their inventory when prices were low and not selling to the market. That wasn't the case. I mean, China continued to produce large volumes of product, carbonate and hydroxide, and shipments of ore, spodumene, to China were consistently high. So what was actually happening, I think, in the latter part of the year was the usual demand burst that usually happens in the fourth quarter of every year. It's highly seasonal, right? So first quarter of the year is usually Chinese New Year. It slows down and then it accelerates through year end. And to a large extent, we started seeing that from October onwards, with the closure of the CATL mine that accounted for maybe about 3% of last year's market, and taking that supply out probably already balanced the market or even pushed it into a slight deficit. But that deficit was masked by inventories, I believe. So while the real market was probably in a slightly short deficit position, inventories started coming down, but nobody really saw that as a big thing until in the last month of the year, suddenly the battery storage story became very, very topical. Brokers started raising their forecasts for grid storage by up to 300% in a single move. Banks and brokerages went from forecasting oversupply in the lithium market as far out as 2030 and beyond, to suddenly even a deficit position this year. And I think I can't remember which bank it was, maybe yesterday or today, just wrote that we could be in an 80,000 ton deficit this year. So I think that's a huge swing, and that probably accounts for that probably explains a large part of the lithium price move this week or in the last couple of weeks.
I would come at it from a slightly different point of view and say that one of the things I would look a little bit more on fundamentals and suggest that one of the things that is different this year to previous years is that output of ESS cells has been extremely strong in the second half of the year. So obviously, and I'm sure we'll talk a little bit later about the juxtaposition between ESS shipments and ESS installations. But ESS shipments and ESS output has been very, very strong, and it's walked all the way through the normal seasonality of the industry. So over the last 4 or 5 years, the seasonality of the industry has been dominated by EV output, and EV output goes into a slow period in November, December, January, February. But the strength in ESS has just walked right over the top of that. And instead of going into that slow period that we would have expected at the end of October, we haven't. And inventories have continued to fall during that period because production of cells has been so strong. So actually, what we're seeing here in terms of lithium prices is based on fundamentals. It's not based on sentiment, in my view. Obviously, sentiment is helping it, but we are actually seeing, as YJ referred to, a clear out in inventories in the lithium space through the system. And it's based on this sort of huge increase in output of ESS cells. Now, the big question for me, and maybe YJ jumps in on it, is obviously we have talked about a build-up of ESS cell inventories in the system. It's not in China, it's not at the producer level, but it's at the consumer level. Now, the big question is, as lithium prices go up, and by God, lithium prices are going up, what is the demand elasticity between cell prices, which are starting to rise now, and ESS? Because my gut feeling is the demand elasticity between ESS and cell prices is much tighter than it is for EVs versus cell prices. In EVs, we saw that, whatever it was, 80% increase in prices before we started to see a weakness in EV demand for cells. Can we handle that in the ESS space, where I think margins are much tighter than they are in EVs? So I'd be interested to get YJ's view on that.
This is an interesting angle because look, I don't think that ESS demand is highly price elastic at the moment. There are a few reasons. One, the negative price wholesale price dynamics that we are seeing in many countries and territories with a lot of solar installed, that is not going away. There's still, in fact, there are more negative hour day ahead pricing days, every year compared to previous years. And that just means that every new solar project needs to be paired with batteries. And at the rate that battery costs have fallen in the last couple of years, the levelized cost of electricity, the LCOE of these projects, solar plus batteries, has come down below even gas-fired power plants. So there's now a nice spread where battery prices can go up and not actually affect the relative economics of the different generation options.
But my question to you is, how tight is that spread? Because I think the big issue with lithium ion is on duration. So we're not just talking about, the direct feed through from cell prices to, from lithium prices to cell prices. We're looking at the lead through from lithium prices to 2 or 3 times cell prices, because at the moment what we're doing is we're doubling and tripling up on lithium ion batteries to get the extended duration, the 4 to 6 hour duration. So that's my big question. If, given the magnitude to which lithium prices have increased, I mean, it's 100 now. It's gone up 100%, I think, in the last year. So, how many times can the ESS market shrug that off, bearing in mind that for every ESS plant in, we're putting 2 or 3 times the lithium ion batteries because of the duration of the cells.
Yeah, I mean, we've also seen the duration, like you mentioned, these project durations get longer and longer. So yes, of course, there is an increase in the upfront capex for these projects. But at the same time, it's nice to have 8-hour batteries. I mean, some of these projects are going 8 hours. There's one in Australia that's going there. Now this year in California, there's going to be another one coming up. I think 125 megawatt times 8-hour project. And I think there's one that's undergoing the approval process in California. That's I think they're targeting, was it 400 megawatts times 8 hours? So yeah, you're absolutely right. It's durations are getting longer, but I don't really see a pressing need for 8-hour storage in most projects. You just really, really need 4 hours. And then that covers the evening peak, and then you flatten out the dark curve on both ends of the curve, and that's sufficient to meet the needs, right? So, I mean, I'm speaking in generalities here because these project economics are way too diverse across all the different countries, and there's no one answer to unify them all, right?
Yeah. Yeah, no, I think that's fair. So, I mean, I think over the last sort of 3 years, we've seen the duration increase from about 2 hours, which was a bog standard lithium ion battery in the past, to just over 4 hours now. And, the view was that if the lithium prices stayed low, if cell prices stayed low, we'd go up to 6 or 8 hour average duration. But the big question is, can we support that on higher lithium prices?
The world does not need to go to 6-8 hour storage. In fact, looking at the biggest picture we have, take the number of gigawatts of solar being installed every year. It was 600 gigawatts in 2024. Last year, it was in the range of probably 750 to 800. The first half was 380. The second half numbers are not out yet. So, but if you just double up the first half, we have 760 gigawatts installed last year. And how much great energy storage are we installing? The numbers that we are tracking last year, installations might be 300 plus gigawatt hours. Shipments were probably in the range of 500 plus gigawatt hours, right? And that was the tension that we had with benchmarks numbers versus our forecasts, right? And that was a fun thing, clearly there's a lot more demand. People are shipping out a lot more cells into the customers' inventories than we thought was going to happen. But come back to the big picture. 760 gigawatts of solar, at max 500 plus gigawatt hours of batteries being shipped, and we have less than 1 hour average at global levels. So we are not even at 1 hour. There's no need to talk about 6-8 hour battery durations. If we can get to 3 hours on average, take 800 gigawatts of solar times 3 hours of storage, it will require 2,400 gigawatt hours of batteries, which will consume all the batteries being produced in the world this year.
I would love to get us there. On my numbers, I don't have us getting to 2,400 until 2030, but your point is well made. Yeah, I think we are fully in agreement on the potential of the energy storage market. How long that takes to deliver, I don't know if it's going to be 5 years or 10 years or whatever, but the energy storage market will be bigger than the EV market probably within the next 5 years, probably less. It's a big situation. The big issue for me is whether we might get a correction this year due to prices moving too high, too fast. And I would say that the risk is rising, but for me, I'm not going to stand in the middle of the market. So I'm not going to stand in the market and go stop. I'm going to enjoy the momentum of the market, but I'm going to be positioned for if there is a correction so I can get out quickly if that's the case.
Well, but Matt, let's not be too pessimistic about the prospects for EVs because I'm looking at my demand model right now, and I can share that if we just even assume market penetration of 45% EVs in 2030, I think the EVs will account for at least 2,700 gigawatt hours of battery demand, and then we add on another 1.5 gigawatt hours from storage, and plus the other sources, and we get to 4.5 million tons of demand. So I still think that EVs will still likely account for the largest share of lithium demand, not yet energy storage, unless we are going full on 2,400 gigawatt hours energy storage by 2030.
I'm a little bit less bullish on EVs, certainly in the next sort of 12 to 18 months. I don't see the EV sales growth growing that fast, but I think certainly the rapid growth from ESS can sort of fill that gap in, I think, in the next 12 to 18 months or so.
Oh, I would agree with you absolutely on the ESS side covering any shortfalls on the EV side, but I don't even think there will be a real shortfall on the EV side. Just a couple of big trends to follow. One is that the Chinese are going absolute ham on the penetration rate. So on the vehicle side, the passenger vehicle side, we are talking 60+% penetration this year, highly likely, and this is the largest market in the world, right? And even on their trucks side, they are at about 1/3 electric already, right? And then on the other side of the world, you are seeing Chinese ship their EVs all the way to markets. They're winning all these developing markets much faster, and essentially they're almost leapfrogging the gasoline/diesel generation.
Mm-hmm. Yeah, I mean, I'm a big believer in sort of what we call the rest of the world, which is world ex China, US, and Europe. I first picked up on that in 23, early 24. And we've seen huge growth there. But for me, I think it's realistic to expect that we'll probably see a slowdown in growth in the US EV story this year, possibly negative growth. I think the Chinese market will grow a little bit slower than it has done in 25. And the jury's still out in Europe. But I totally agree with you that the rest of the world is going to be a very, very strong EV market going forward.
Yeah, well, as Benji witnessed and you witnessed, Matt, when you visited me, the full self-driving in our Tesla has made me a believer in autonomy, and with Waymo and robo-taxis and things like that. I don't know that they'll be massively deployed in 2026, but that's coming, right? And that as a use case for electric vehicles. And the bromance between Elon and Trump, they had a dinner, also with Melania, he tweeted about. So that's back on. I think I've argued, and we'll hear more about this, that the negative headwind against EVs, right? I think that noise is out. I think you're going to see a pivot to batteries and AI and military, grid storage, those applications. But I also think you'll see a softening of this anti-EV rhetoric, from Trump and the administration, because that was last year's legislation, and narrative. So we'll see. But YJ, like, so you said a lot of the brokers went from oversupply until like 2028, 2029 to like undersupply by this year because, energy storage, which they never really can get their head around, like EVs, they have big teams in the auto sector that kind of just figured out penetration rates. They kind of really weren't able to analyze energy storage, but now they're suddenly increasing their energy storage, numbers. Are they suddenly smart on energy storage, right? Or is like all of these other applications that are hard to get data on, hard to analyze, and Iola Hughes at Benchmark does as good a job as she can, as possible, and her team. But like, are we, and we focused so far all on demand. I want to like turn to supply in a minute because supply is also opaque, but the demand side just seems still quite opaque, right? Like we're guessing, it feels good. But how comfortable are you with all of these, endless demand, from these other applications?
Well, I mean, maybe I'll just jump in before YJ starts. But one of the things that I would pick up on sell side forecasts, and it's something that YJ's picked up extensively on X and elsewhere, is that a lot of these bulge bracket brokers, they're only forecasting for 2 years explicitly. And then they're forecasting basically flat demand post, that 2 year period. And I mean, no offense, but it's nuts. Demand's not just going to fall off a cliff. So yeah, I mean, it's all right that you come in and forecast a hockey stick for 2 years, but your hockey stick doesn't then collapse. And
it's a broken hockey stick.
Yeah, broken hockey sticks. That's where a lot of the brokers are going wrong, I think, in terms of the space. It's nice that they're starting to get their near-term forecasts a little bit closer, but they got to get their medium and longer-term forecasts sorted out as well.
I mean, I was on the sell side for 6.5 years in my early career, so I know exactly how the game is played. Nobody wants to stick their neck out that far, And if you are right, and you're right in the next 2 years, you can be a star. You can already be a star. So why go to that full length, right? But for us, we are more concerned with seeing the whole big picture, and to the extent that we are not afraid to put a wild number out, what sounds like a wild number. When Albemarle is forecasting 2.8 million tons market in 2030, and we are saying it's 4.6 million tons, then by all means, right? Why not? So demand side, back to answering Howard's question. I am very confident in the energy storage story, which is why we pounded the table on this for the whole of last year, from the start to the end of last year. And in fact, even from June onwards, I was even more convinced because I learned at the Fast Markets conference that the internal rate of return on these projects in China were ridiculous. We are talking grid scale batteries, payback period of 5 years. Commercial BESS, which is just a little companies putting little projects together and just making money quickly, has a payback period of less than 1.5 years. And how they're doing it, they are buying cheap batteries from second, third tier battery manufacturers, putting them in place, and doing not just the usual discharge in the afternoon to the evening peak, but also charging at midnight and discharging into the morning peak. It's a smaller margin, but you are running the asset twice a day. You are squeezing that extra bit of yield out of it, and combined with the low cost that you get from the second, third tier manufacturers, you get a 1.5 year payback. So that gave me the confidence that this market is going to be a lot bigger than people think, because with this sort of economic returns, you are going to go in big time, right? And that's exactly what we are seeing right now. And I don't think that goes away in the near term because there's just so much arbitrage to be made in the energy markets between those hours. And with battery prices having fallen and not actually gone up all that much, even though lithium prices are starting to move, those economics still remain. So maybe this answers your earlier question on how much sensitivity or elasticity there could be. And this probably adds a little bit more to the idea that the demand elasticity is not that high. People are willing to absorb a slightly higher price because the project IRRs are that high. So on the demand side, the energy storage, I think even my numbers could be raised in the next couple of years. I'm already one of the most bullish out there, but there is room for further increase if the market, if the data actually back it up. The other sides of demand, EVs, I've already spoken about it. Trucks is the other big market that I started talking about last year, and I will continue to pound the table on this year. Okay, it's huge. It's going to be big. It starts from nothing, less than 100 kilotons of lithium demand last year and probably this year. But in the next few years, it's going to grow at exponential rates until it's a few hundred kilotons of demand, and then it's not insignificant anymore. There were some people that made a mockery of my energy storage forecasts early last year. They said that it was not it was too small demand factor to even bother talking about. And by November and December, that all changed, right? And I think the same thing happens with trucks this year. And of course, we haven't even got to the more interesting demand sectors like flying taxis, eVTOLs, which are being tested in China and could be a real thing in the next few years. Ships and passenger ferries, cargo ferries, river ferries are going electric as well. Each one of those vessels has a 40, 50 megawatt hour battery.
And can I just ask a little bit more detail on that? Is that those are battery swapping, I assume? That's not like a recharging sort of situation. They'll swap the battery out.
Some are swappable, but some are recharged.
Really?
Yeah, the passenger ferry, the passenger ferry ones, I didn't see any capability for swapping.
Right. Wow. Okay. Interesting.
Again, I was walking around here with Benji, and like from a truck perspective in America, I was always upset that Elon Musk didn't build the semis much faster, right? If he was really all about sustainability, right? Regular trucks are so polluting and they're so noisy. Like when you're behind them, like just I want them gone, right? We want electric trucks here in America. And then also leaf blowers, right? This may not be a huge demand driver, but sometimes we're podcasting here and my gardener is just, blowing the leaves here and it's deafening. I can't hear. So just from a
you
noise
should gift him an electric leaf blower then, shouldn't you?
Well,
well, nobody's
put your money where your mouth is.
They are a little bit more expensive, but and I think they're a little bit heavier, maybe, and they do need to be recharged.
There are electric leaf blowers there already.
Oh yeah,
there are, and some states are mandating it, right? They're forcing them, and then the Democratic states are, and then the Republicans are saying, why are you forcing these guys to buy more expensive? But just overall noise, right? And the smell, in localized neighborhood, they couldn't be replaced fast enough, in my opinion. And
I would sort of add my tuppence to that and say that in Europe, there's actually been quite reasonable growth in light commercial vehicles, not so much on the heavy commercial side, but certainly on the light commercial. The sort of neighborhood vehicles that are sort of going around on a fixed route and everything. UPS, Amazon, a lot of major delivery companies now all operate electric vehicles in the UK and elsewhere in Europe, and that's been a big growth area. We don't have as big a sort of heavy trucking industry. Europe has a bigger heavy trucking industry, but I think China and the US are the biggest heavy trucking industries in the world.
Yep, absolutely. Hey, I didn't even know about the electric blower thing, but I think that's another sign
It's a
of
small
this.
battery.
It's a
You have to buy a lot of electric blowers.
It's a small one, but I mean, look at some of the markets like drones, right? Now they're putting up drone shows, tens of thousands of drones per show. These all add up, and then of course the unfortunate use of drones in the military, especially those one-use types. I mean, I don't like it, but it is what it is. It's happening. It will add to some demand. So this is basically
robots will need batteries. There's all sorts of applications.
Yep. Yeah. So this is the electrification, the batterification of everything, right?
Yep. So I want to turn to supply, but I'll just make a comment. I just remember, Deutsche Bank in 2015 or 2016 had these forecasts for what lithium might be in 2025, and the numbers were like 500,000 or 600,000 tons, right? Now it's 1.5 million. So they vastly underestimated demand. We all thought that supply could never keep up. Supply did keep up for a period of time. So now let's talk about supply, right? Like the narrative a year and a half ago was that there's all this latent supply that, Minres Wagner, Pilbara, P2000. There's an overcapacity of conversion capacity, in China. So as soon as price rises, all of a sudden these things are going to be turned back on. Core lithium stock is soaring, right? Because that's like a restart. Minres got Bald Hill, right? I'm seeing Nigeria's supply, potential coming from various places. On the flip side, I don't really know what's happening in China with lepidolite and the involution and turning off some of these mines and licensing, etc. Then there's SQM. They just finalized their joint venture with Codelco. We could talk about that. That's been a big source of supply over the prior years. Underreported. We've talked about it. Like the supply from SQM has been as much or more than the lepidolite, an African supply. But now that this joint venture is bedded down, what's the supply growth potentially going to come from SQM? You got Rio Tinto, well capitalized, now can execute any and all of the plans. So what's your read on that?
Where do I even begin, Howard? Let's see. Maybe we start from the big picture, right? So in the past, it was easy to tip the market into oversupply, which was exactly what happened in the last cycle in December 2022, when lithium peaked at a spot of 80,000 a ton. And then China went into lepidolite, went into Africa, brought about 150 to 200 kilotons new supply to the market. That tipped the entire thing, right? And then we were basically consuming this oversupply for the next 2 years. But now we are past that. So, 3 years even to end of 2025. But now we are past that. So the market was 1.5 million tons last year. This year is likely to be 2 million. I'm not changing my forecast. Ganfeng and Tianqi chairman both came out to say that it's a 2 million market, or it's a 30+% growth this year. So we are all centered on the 2 million ton market for this year. And
that's huge. Sorry, from 1.5 to 2 in 1 year, 500,000 tons of additional demand in 2026.
Absolutely.
That's insane.
The chairman of both Ganfeng and Tianqi came out to give these numbers. So I'm not the only one that's calling for a 33% growth in the market this year. All right. Now
that was a high case, I think, not their base case, right?
No, that's their base case.
Their base case.
Yes.
Wow.
So
I'm going to just interrupt for 1 second. If there's one thing that there has been consensus on in the last kind of like 2 years, 3 years, is that everyone says lithium's going to rise in price, but no way is it ever going to get to 80,000 again. It's not going to go as high as that. So could that be wrong?
I think there is a possibility. I would not say that is I mean nothing's ever impossible. Less likely because it's also easier for a small market to be disrupted on way too much on the high side. Perhaps less likely, but given inflation in the long term, who knows, nominal prices could go back up to those levels. Wouldn't be surprised.
And to be fair, when spot hit 80, if you look at SQM's price that quarter at peak, their price peaked at like 54,000, I think.
50 plus,
something like that.
Correct.
Yeah. So that's really kind of the number. Like, can we reach 50 in a quarter, 50 to 60, will Albemarle or SQM or Rio Tinto print? Anyway, we'll see. But go ahead. I won't interrupt.
Yep. So, that price level could be achieved if the demand picture developed as our model says it could. So last year and I'm not changing the model numbers. I'm still holding these numbers here. Demand this year is 2 million tons. Next year is 2.5 million. The following year is 3.2 million tons. So we are talking about the market growing 500 kilotons and in these 2 years, 25 and 26, and 600, almost 700 kilotons in 2028. And if we compare that to the supply side of the market last year, 1.5 million tons of capacity actually delivering. Can the world bring on 33% of new capacity of last year's capacity online every single year for the next 3 to 5 years? So
no way. Well, you're saying adding 1.7 million tons, in the next 2 years or 3 years.
Exactly. But if battery storage goes the way we think it will, and EV penetration across China, Europe, Africa, and other middle income countries go the way we think it will, and trucks go from nearly nothing in global penetration to a quarter or a third by the end of the decade, we are talking multiple 100 kilotons of deficit. And if we hit multiple 100 kilotons of deficit in the next few years, we could see prices go back where they were. Why not?
Can we just talk a little bit about numbers? So how much have you got in for supply and demand in, say, 2024?
2024, slightly above 1.2 million tons in supply and slightly below 1.2 million tons in demand, with a supply gap, with an oversupply of 53,000 tons.
Okay. And then in 2025, you said 1.5 million tons of demand.
My model balances in this year. So essentially there was an oversupply in the first half of the year that swung to an undersupply in the second half. It balanced out. The net is a 16 kiloton slight oversupply. It's less than one boatload's worth.
Okay, cool.
Yeah. And this year, I'm actually looking at more than 100 kilotons of deficit.
Okay. So I'm not quite that bullish, but I am bullish on 26. But I'm not as bullish as that. But I also forecast a small deficit in 26 as well.
Yep. I look forward to helping you raise your energy storage forecasts again.
But why, Jay? Okay, so I mean, if demand is that big, all of the latent supply that I just alluded to from SQM, PLS, etc., they're not going to be. Could you quantify how much lithium units, come from things that could be turned on within 12 months, 24 months?
Okay. What I do, I mean, just to recap my process here, I track currently 142 lithium mines around the world. I include, if there's a brownfield expansion, I don't have a separate line for that. Okay. Unlike I think some of the consultants or database providers out there, a brownfield expansion is a separate project for them, so they might say that they are tracking over 200 lithium projects, but that's not the real number of mines. So 142 lithium mines, and for SQM, there's not going to be a lot of extra new supply from SQM. For them, last year they probably produced around 210 kilotons LCE. This year they might go up to 230, and then it slowly goes up towards 300 by the end of this decade. And then
that's just SQM in Chile, yeah?
Yeah, that's just SQM in Chile. I mean, we are not talking about Mount Holland, are we?
Yeah, that's fine.
Yeah, no, Mount Holland. Anyway, that's
it was SQM in Chile that was able to. That 210 number is up from like 50, right? So they added a lot more in the past few years than they're going to be able to add in the next few years.
Yeah, I mean, they were 50 in 2018, I think, and then they grew to 210 in 2025. So, 7 years.
7 years.
They grew their supply by 160 kilotons. That was huge. But they are not going to put that growth into the market over the next 7 years. They can grow it to 300 kilotons at maximum by 2030. And then afterwards, their new deal with CATL, they can grow it to 330 in the foreseeable future. But from 300 to 330, that's a rounding error, man. That's nothing much. So SQM, is really not much volume growth contribution to the global market that I'm seeing. So a lot of the new supply could probably come from big projects like you rightly pointed out, Pilbara's P2000. So right now, that could be a large incremental growth, and of course, we have Thacker Pass coming online in 28, onwards, and that could be another 40 kilotons.
We got Wodgina. It can train 3, 4, 5. He always talked about. Greenbushes.
I also I don't think we should forget Argentina. I mean, potentially there's a lot of supply to come on in Argentina.
Correct. Like Wodgina could almost treble their production from 2025, going from about just under 40 kilotons to essentially 120 in the next few years. So that is something to look out for as well. If we want to look at the big picture, let me try to find my country or regional numbers.
So I just to fill in some gaps, I've got a around about 80% increase in Argentinian production in 26. As you say, a little bit in Chile. I've got a fair amount in China from brine, including DLE, and also from hard rock. I've got a bit in Australia, quite a lot in Africa, and then some odds and sods elsewhere around the world.
Yep. This year, I'm looking at, I think I broadly agree with you. Argentina, not 80%, but last year they might have done around 110 kilotons. This year, I'm looking at almost 170. So maybe 40-50% growth. China, yes, could go from about 400 kilotons to about 550 kilotons. That's another big 150 kiloton growth. So a lot of new mines and new supply coming from China this year. But at the same time, we're talking about 33% demand growth, right? So I'm not so worried. Nothing from Europe. Africa, yes, could go from 200 to 250, 270 kilotons by this year.
How much conversion capacity is there in China? So like there is talk that all of the price, all the value of the price increase is accruing to the miners, and the converters don't make any money at present because there's so much overcapacity. But is there enough capacity to meet, the 500,000 ton growth you're expecting this year and then again next year? Or do they have to build more? Is there a bottleneck on conversion in addition to just, raw material supply? Because if not, history has shown that like spodumene mines can kind of like get up and running relatively quickly to fill, undersupply.
Actually, I would still say that the lead time for building converters is shorter than bringing a new mine to the market. What China did in Africa in 2022, and more like 23 and 4, was they didn't even drill. They didn't even do mine plans. They went in, they saw white rock, they dug it, they shipped it out, right? They skipped the entire usual mining process. Drilling for years, modeling out the underground reserves, doing a mine plan for the next so that this mine can operate efficiently for the next 8 to 20 plus years. Correct? None of that was done in a lot of places in Africa. They just went straight to the outcrops that they saw and just started mining.
And there still is that, right? I think I saw a company, Chariot, has an MOU in Nigeria with some unnamed or some name I never heard of in China, right?
Yeah, even at the national government backed. No, they're not actually government backed. They're private, but in a sense, the national direction is towards that. Even with that push, you could maybe bring on over 2 years 100 kilotons of new supply. But these will not be long-term supply because you don't have a mine plan. You don't know what the reserve or resource underground is. You see some rock, you dig, and then the next thing you go, once you go below the surface, suddenly there's no more resource, right? That could happen. So, which is why I think eventually, if you want long-term sustainable supply, you still need to go through the usual process. Prove the resource, build a proper mine around it. Otherwise, it's hit or miss, right? So, converter supply, back to the question, or converter capacity, it probably eventually over the rest of this decade will prove to be less of a concern because the Chinese know how to build converters. They know how to run it. They can essentially modularize and build new trains pretty efficiently. I don't think there's a bottleneck there.
Okay. We've been going a bit long here, so I just want to kind of like summarize. Basically, March of last year, you came on Rockstock Channel and we named that, titled it Lithium's Imminent Demand Surprises, something to that effect. So those surprises are now here, and you're doubling down on the demand. Is we're you predicted it, but it's going until 2028, way higher than. And again, you said 4.6 million tons by 2030. You said Albemarle is at 2.8. I think that's their low end. I think they're between 2.8 and 3.3, but still 4.6 where you are is outlier bullish. No one's anywhere close to you. And you were at 4.3 and then you raised it in July. And you're saying everything you're seeing supports that. And if that's the case, I can't see how supply could keep up if you're right on those demand numbers.
Yeah, even my best case supply with all 142 mines producing in 2030, i.e. no mine delays, no mines face financing issues or execution issues, the maximum supply that can reach the market from lithium mines is just under 4 million. It's 3.95 million tons LCE according to my model. And therefore in 2030, we are looking at a 600 kiloton deficit by my model, but we'll be at a 400 kiloton deficit in 2029 anyway. So the increase in the deficit is probably immaterial. So by that time, if my forecasts are right, then lithium price is very, very high. That incentivizes new supply, for example, sodium batteries, to come in and take a share of the market. I don't think sodium will replace lithium, but it could take a share of the market, especially for use cases like grid storage.
Right. Okay. That was always the story. There's still trade-offs. Sodium ion hasn't, cost is a trade-off. So analysts like Baron Joey, who was out there a couple of weeks ago with very high, I think they said 3,200 spodumene price for this year. Spodumene's now pushing like 1,800. And when we had Chris Robb on with you, he said, like, look, if you're right, YJ, in a bull market, right, the companies with the most upside are all the, what do you call it? I think rats and mice, small projects, right? So you've had the big caps running, the Pilbaras and the Albemarles, and there's been short covering. I haven't seen how much the short interest has declined, but it certainly must be declining. And then, so the producers run first. There's a lot of people out there that say, oh, I'm happy to miss the first 30 to 50% upside. Now you've missed like the first 100 to 150% upside. But if you believe this story has legs, there are still a bunch of sub 100 million market cap speculations that, should get, could double, triple from here as, your thesis is there's not enough supply. Then all of those marginal projects and ones that are further away, people start believing like we're going to need that too, right? I mean, there's a lot of hope, of sediments. There are 5 or 6 other, Thacker Pass wannabes, right? Like Surge Battery Materials and Jindalee and a few others, American Battery. And then in the smack over, you have Exxon and Standard Lithium is heading toward this. You got Vulcan, funded. I know you have a view on Vulcan and Thacker Pass and their capital intensity, et cetera, but like the world will need all of these projects, right? And they'll need, the high grade, Patriots and Q2s and Moblans and Alevras and Sigmas out of Brazil and Lithium Ionic. Like all of these things are going to be needed. And some of those stocks have started to run. And so, and we're at 17,000 chemical price or something like that, right? If we're going to 50, then brokers are going to keep increasing their earnings forecasts. The Pilbara, which is still sitting on a mound of cash from the last bull cycle, right, is going to start minting cat. Right, these are going to become real software margins, to harken back to Elon Musk's statement again, if you're right. So let's hope you are. You have been for a while. We're nearly at an hour here. So just final thoughts on, I know you liked silver and Matt likes silver. So if we could just, end on that and yeah.
Well, for this lithium market, I mean, what you've mentioned there is probably all true, but I think lithium, the commodity, is likely to remain cyclical. While I think a structural deficit might and probably could form, I could be wrong as well, right? And then there could be periods of short-term sudden oversupply, right? If some large new mines come on simultaneously, that could just flood the market for the short term, and then price could crash. So, and then there will be companies whose projects may never come to market, yet they enjoy huge market caps. We saw that happen in the last cycle, and I would always caution investors. I mean, I approach this as a professional investor, as a fund manager. Chris, I mean, that discussion with Chris Robb some time ago. Yes, he's right in the sense that in a bull market, the lowest quality assets and companies move the most. But are those the ones that I want to invest for my investors? I don't think so, right? So I would say to maintain a little bit of caution even in the bull market, and try not to play too hard on those high beta plays. Yeah. So
Appreciate your word of caution, and all of this is not financial advice, absolutely, but there are nevertheless high quality projects that are just and that are highly probable at an incentive price, but they had to slow down because their equity was too low and they couldn't get financing because it's still a very immature industry, and the financing tools and knowledge base, and then you also have competing narratives now. Like a last bull cycle in lithium was kind of like a loan. Nothing else was going up. Now copper is going up, silver is going up, gold's going up. Like the bankers are making, and the fund managers. So lithium's actually competing for mind share, and dollar share. And people still don't understand the market so well. So they're, but yeah, it'll be cyclical. I hear you. And what's going to be interesting is the quarterly results are going to start coming out. I think Pilbara is usually first. So by the end of January into February, you're going to have all this commentary, and I'm going to be, apart from the market commentary, I'm going to be listening very keenly because everyone's going to be asking, okay, Dale, when are you hitting the bid on, what used to be Altura, like, and restarting that? When are you going to grow to P2000? And then the market will be like, okay, that supply is well funded, that's highly probable, that's coming on, and maybe YJ is not right. Maybe it there'll be a hiccup for whatever reason, and we could have a couple of quarters where price comes in. But it's interesting, like Matt, you commented about there has been a predictable seasonality to lithium. Like someone emailed me, someone who covers Tesla and other, he's not a lithium follower, so much, but he covers, Tesla, he covers Albemarle. And he's just like, Howard, how much of the lithium price move is related to buying ahead of the Lunar New Year versus stable price increase in your view, right? Like, so he's someone who kind of comes in and out. He has a few data points. He's remembering, previous seasonality, but you guys, I think, are arguing that this year something's different.
Yeah.
Okay. Well, with that, I thought maybe you'd have a little bit more to say, but okay, fine.
Well, Howard. But one thing that I could mention is that this lithium bull market could be disrupted not by a fundamental shift, in a sense that this deficit could be structural and could continue growing, but it could be disrupted by an entire narrative shift. So, what if this year the US goes into a recession, the AI bubble bursts, stock markets collapse, and then suddenly lithium is out of favor, because then the story will be we are in a recession, nobody's buying fancy electric cars anymore, demand is going to fall, and then the price starts collapsing, and when the markets fall anyway, everything correlates. People will take profit from your 100% gains in SQM, in Albemarle, and they will be sold down hard because they've gone up so much. So that could be, the volatility.
Very good point. And there is a lot of optimism now. So we should all, just like when there was too much pessimism, you want to be a contrarian, you buy. I don't know that we're at a peak optimism point. I think the critical minerals narrative and, US GDP print was, exceeding expectations. Unemployment is better. Inflation is okay. We're going to have rate cuts. So I think the probability of recession in the US is low. We didn't talk at all about geopolitics and tariffs and China versus ex-China, but I think actually the ability of China to just go into Africa and take assets to supply their machine is less, right? And you see that with the U.S. government intervening, with AVZ and Monono, and other places and other commodities. So it's good that you put a caveat there, like if there is a market crash, or if there is a recession and a market crash, we could point to this segment of the video and say, "I warned you."
I mean, just on the recession thing, I won't sort of focus on this for a long time, but the headline GDP number is one number, but the numbers underneath that, the data underneath that, they're not positive. So
yes, and are the inflation numbers real? A lot of it was proxied; they were not collected because the government was shut down.
Yeah. So if you look at the IP data, the manufacturing data, the retail sales data, all of that sort of stuff, that's not positive, even though the headline data pretty reasonable.
Truck sales are down by half in the US year on year. Unemployment is actually up. Blue collar jobs are not looking good. So the real economy is
fair enough. I must listen too much to the All In podcast and a lot of the voices from the Trump administration, and I'm having a more of an optimistic view on things, but you guys could be right. It could not be. It's possible it's not as good as we're forecasting, and that's the beauty of markets, etc. So one thing I learned from Matt, in the run up in October on the rare earths enthusiasm is, and I'd recommend all investors here, put trailing stop, orders on your gains, meaning like I put, 10 to 20% stop. So if major stocks are going up and all of a sudden, things are down 30, 40%, you get stopped out and you didn't take the 30% or 40% loss. You took the 10 or 20% loss. And it's as it keeps going higher, anyway, stop losses, something I never used before until last October. And it helped me greatly with a number of rare earth stories and even some lithium stories, which had gotten way ahead of themselves, and some graphite stories. And then I re-entered them. The ones that I thought, especially on lithium, because I felt, they were far from overvalued, whereas some of the rats and mice in rare earths and other stories were running too hard. Okay. Anyhow, thank you.
Just coming back to October, because I think October was a really important point in critical materials markets, because a lot of risk came off in the sector, and as we discussed in lithium, it came back on again, but in a lot of critical materials it didn't. And obviously we could talk about rare earths, we could talk about graphite, but let's talk about silver very quickly, because this is an industry where I see a huge physical market imbalance, but I see a paper market that is not reacting to that. So can you talk a little bit about your views on silver?
Well, I was a huge silver bull last year. I continue to be one. In fact, my portfolio is weighted more heavily towards gold and silver than even lithium for last year. So so actually we did pretty well. Returns last year were comfortably above 100%. Silver, what is going on in that market is that solar went from nothing in the market to a quarter, maybe, and maybe even 30% of the market. And that pushed the silver physical market into a deficit for the last 4 years. So what's been happening is that the industry has basically been melting down silver bars, silver coins, bullion essentially, and then putting them into solar panels, and then they are sequestered away for the next 25 years, because that's how long solar panels last. So global and how this deficit has been essentially met is this above ground inventory of silver bullion. And we all knew this inventory has a limit. The only question was, how big is this inventory? Nobody knew, because everybody has goals, has silver bars stacked somewhere. When prices went up, they came off the woodwork. Prices stayed low for a very long time. 2024, it started moving $20 to $30. 2025, last year, it went from 30 to 70 plus, right? And I think this year, it can continue to go up for a few reasons. One, it is still pegged. The silver price does still continue moving with gold. And I think gold has a little bit more upside as well because of the huge geopolitical mess that we are seeing right now. The debasement trade is still ongoing. USD strength is probably as in weaker dollar is the aim of the Trump administration, and lower interest rates, and those tend to be positive for gold prices. So that pulls silver up along with it. But silver has its own internal dynamic, which is the solar demand. There's a physical over demand, under supply story right there, which is now only making itself known in the physical market. So you're right. Chinese prices are used to be just a couple dollars above the US London markets. Now they're as high as $8-10 above.
And the Chinese have halted exports of silver as well.
Well, yeah, I mean, it's not a real halt. The large players can continue to export. They have the license, they have the permission. But China was always a large producer and a large trader of silver, so it moves in and out of the market according to the market prices. I don't really see this policy as really having a huge impact on the silver market. It is more the industry demand story that continues to pull the silver price up.
Okay. Yeah, I mean, it's very interesting. I'm on X a lot at the moment. There's all sorts of conspiracy theories left, right, and center about silver paper markets versus physical. But
and the bullion banks trying to suppress the paper price on the markets, right?
Exactly.
There's probably some truth to it.
Yeah, I don't care about the noise because I look at the supply demand model, and the supply demand model is so significant. I haven't seen a market like that in 10 or 15 years, not since the early 2000s. So I'm sort of, I don't really care about the noise in the silver market. If the guys who are manipulating the market do well enough to lower the price, then I look at that as a buying opportunity. Obviously, do your own research, not advice. But for me, any time that there's a significant correction at the moment, it's a buying opportunity because I just see the supply demand imbalance, and it's crazy.
I have been doing that, and I think the silver market is a great learning source for us to see how the markets react or how they move and develop in a structural deficit story, because the demand for silver continues to go up while the supply is not growing. So the deficit is growing every single year, and let's see where prices move and how far they correct, and whether there could be an analogy to be drawn to the lithium market if such a supply structural deficit develops.
To be continued. One story that I don't own any silver stocks, but one client of ours, and we've had on this podcast before, is Lithium Universe, Iggy Tan, who has both lithium story, converter story in Quebec as well as in the US now, but also has a silver recycling story. So anyhow, we hope to have him back on the program at some point, but he could be correlated to two structural deficit stories, lithium and silver. Anyhow, we got to go. We got another call here in 2 minutes, YJ. So thank you very much for spending so much time with us this late at the beginning of the year. And I hope you're mostly right, or I hope you're right about most of what your commentary here, and that your U.S. recession idea is postponed.
Nobody wants a recession, yeah?
Okay. Take care, YJ.
Okay, thanks, YJ.
Thank you, guys. Thank you.
Cheers. I'd also like to thank our sponsor, USCF Investments, which is a pioneer in commodity ETFs for nearly 20 years. Their 15 funds include single commodity exposure, broad diversification with SDCI, and themes like ZSB for battery metals and USG for gold with income. To find out more, watch our inaugural episode with their CEO, John Love, and visit uscfinvestments.com.